3 consecutive losing sessions. The S&P 500 is bleeding. And rising bond yields are the knife. This just happened. And most investors don't realize what it means yet. Here's what's really going on. And what you should be thinking about right now. Because if one veteran strategist is right, the Fed's next move won't be a cut. It'll be a hike. Right now, bond yields are rising. And they're taking stocks down with them. 3 straight sessions of losses. The Dow, the S&P 500, the Nasdaq, all falling. In unison. Rising yields aren't just a number on a screen. They reprice every asset you own. Growth stocks, REITs, rate-sensitive holdings. All of them feel the pressure when yields push higher. Ed Yardeni, a strategist with decades of market experience, went on CNBC and dropped a bombshell. He warned the Federal Reserve may be forced to raise interest rates in July. Not cut, raise. The mechanism? Bond vigilantes. That's the market term for large fixed-income investors who sell treasuries, driving yields higher. To punish fiscal and monetary policy they don't trust when vigilantes move. Central banks are forced to respond. Meanwhile, a Reuters poll shows most economists expect 0 rate cuts in 2025. Not one. The pivot narrative? It's evaporating in real time. And Morgan Stanley just reset its rate cut forecast. All the way out to 2027. Let that sink in. 2 full years from now before rates potentially ease. But here's what nobody is saying about this yet. A rate hike in July wouldn't just be a policy shift. It would be a psychological earthquake for equity markets. Because for 2 years, Wall Street has been pricing in eventual relief. Lower rates, multiple expansion, a return to easy money. A July hike blows that entire thesis up. Valuations built on Fed patience don't survive a Fed that pivots hawkish. That's the scenario Yardeni just put on the table. And most retail investors haven't even begun to price it in. First, review your rate-sensitive exposure right now. REITs and long-duration growth stocks are the most vulnerable in a rising yield environment. Know what you're holding before the next Fed meeting. Second, understand duration risk in your fixed income positions. Longer duration bonds lose more value when yields rise. If you're in bond funds, check the average duration today. Third, consider how a prolonged high-rate environment, potentially through 2027 per Morgan Stanley, reshapes your entire asset allocation framework. This isn't a short-term headwind. It may be the new baseline. A July rate hike. Bond vigilantes calling the shots. Morgan Stanley penciling in 2027 for relief. What do you think this means for your portfolio? Drop it below. This video is for educational purposes only, not financial advice. Always consult a qualified advisor before making any investment decisions.